we continue to be very, very constructive on the markets. We believe that this is not just a liquidity driven market, but also a market which is driven by earnings growth. We are now moving away from these olden days where you had subsidies and borrowings which were largely outside the budget and which were shoved under the carpet. But I think we are having a great new beginning where the budget is not only realistic but is also very, very transparent. Feel good of the budget to the fear of an all-out war in Russia and Ukraine. And that's how life is, right? Things can change pretty quickly just when you think that we will settle down into some sort of normalcy. And we were all looking forward to that at least now in 22-23, after the third wave of COVID, consumers and businesses and the government can get down to business and living a very normal life. Discretionary spending is beginning to rise fast. As we exit the third wave of Omicron, we are seeing activity levels zoom. Today, whether you look at holidays, travel, recreation, movies, people going out to restaurants, we are seeing a massive spike. As a result of which, we believe that the markets are already positioning themselves for a strong revival of the economy. In my view, as I said, while it may create some headwinds in the near to medium term, it does not alter our very positive view on markets, because our belief is that the markets from here on will be driven less by liquidity and more by earnings growth. As long-term investors, we need to focus on substantive issues, because sentiment can be good or bad. Flows from foreign institutional investors were significantly negative. But amongst all of this, do we see a silver line? And what matters at the end of the day to markets in the long run is only one thing, which is earnings. All the other markets have seen a substantial cut in earnings estimates. And in India, as I mentioned last month, after an initial small cut, the earnings estimates have remained reasonably resilient. And we do believe that India continues to grow. The numbers give us a lot of confidence that there is an underlying momentum in the economy. Truly, we have seen a big turning point when it comes to domestic equity flows into equity markets. We've talked about it. And as I mentioned, one of the structural reasons why Mr. Jhunjhunwala was so bullish on the Indian equity markets was because he always predicted that the amount of Indian money that will come into the Indian equity markets will far, far outpace what the FIIs have put in. And believe you me, as our demographics is so young, which means that more and more people are saving and earning, this ratio will only go up. This festive Diwali or season is likely to be a blockbuster season as far as consumption trends are concerned. It is quite staggering to see that many developed countries have spent anywhere between 15 to 35% of GDP as stimulus. And India stood completely different and spent only 3.5% of GDP. It is quite heartening. The investment cycle has kicked off in India. So I think India is entering into a phase where businesses are having the confidence to start to invest again. And that's why we have been so confident that the recovery and the resilience that we are seeing in the Indian economy and the Indian markets is far more sustainable and is based on long-term factors rather than just short-term factors like the rebound in consumption. Therefore, if you really look at what's happening in the markets, is that while Nifty is at a new high, the broader markets have struggled. And that has largely to do with the fact that we have seen an impact on profitability in the first half of the year. So how should we think about what is likely to be going forward? If you look at the cumulative impact on Nifty earnings as a result of the first half softer margins, is that we've roughly seen a cut of 6% in the earnings estimate of Nifty companies after continuously 7 quarterly cycles of upgrade. So you can think of it like an intermission in a movie, right? रुकावट के लिए खेद है.